One of the questions we get asked a lot concerns the medical loss ratio for health insurance companies. Now, the medical loss ratio has been around, but with the implementation of the Affordable Care Act, it became a requirement. And what the Affordable Care Act did was it established a minimum threshold that a health insurance company has to pay. So in other words, they have to pay a minimum amount of their premiums out in claims. Now, if a health insurance company doesn't do that, then they may be subject to rebating a portion of those revenues until they get back into compliance with the regulation. Now, there are a lot of different names for the medical loss ratio. We also call it the medical benefits ratio, or a medical cost ratio, or a medical expense ratio, or just a benefits ratio. What it does is we take the claims paid and divide it by the premiums earned over the year. So for a certain level of premiums earned, as the claims go up, so does the medical loss ratio. Now, again, I said there were limits, and depending on the type of business that you have in your book of business, you may be required to pay a little more or a little less. For government plans, a health insurance company has to pay at least 85% of their premiums in claims. That would include Medicare, Medicaid type plans. For large group plans, again, 85%. And for small group and individual plans, a health insurance company has to pay 80% of their premiums out in claims. Now, if you're looking at a health insurance company like a United Healthcare or a CVS Health or Humana, those types of companies, you'll notice that their medical loss ratio will go anywhere from 80% and higher. That's going to be an average across all of their books of business. And remember, if it goes below this threshold, they'll have to rebate back a little bit of that premiums to get back into compliance. Hope this helps. Again, medical loss ratio is a minimum ratio of benefits that a health insurance has to pay compared to the premiums that they've earned.